Okay, so it is Monday, February 23, 2026. And if you are looking at a chart of spot gold right now, you are literally witnessing history. We just shattered records, hitting $5,227.79 per ounce.
Yeah, it is a massive move. I mean, the market is reacting violently to that Supreme Court ruling on tariffs and then the immediate follow-up from the Trump administration, that 15% global tariff announcement.
Right, which sent capital fleeing into hard assets basically instantly.
Hmm.
But we aren't just here to marvel at the price tag. We've got our hands on a very specific technical analysis and execution strategy document that breaks down exactly how traders are navigating all this volatility.
Right.
So the mission for this deep dive is to unpack why gold is acting as the ultimate safe haven today, and then walk through the 3 execution strategies outlined in the source material for capitalizing on the momentum.
Let's start with the market psychology first, because, there is a data anomaly in the report that basically tells the whole story. The analysts highlight that the current low for the day was actually identical to the current open. So $5,107.05.
Which is, that is incredibly rare for a highly liquid asset like gold. It implies that from the very millisecond the market opened, there were just 0 sellers.
Exactly. 0. It was pure, aggressive, institutional buying right from the opening bell, and the volume absolutely confirms it. We saw a 20.8% volume spike to over 167,000 contracts.
Wow.
So this isn't retail speculation. This is big money looking for a bunker because of the tariff news.
Right. So with that kind of intense momentum, the big question for you is how to actually enter the trade without getting your face ripped off. The source outlines 3 distinct strategies. Let's look at the first one, which they call Execution A, the high momentum breakout.
This one is definitely for the aggressive trader. The strategy here is to wait for a 15-minute candle to close above the current high of $5,237.53. You aren't looking for a bargain with this one. You're betting that the tariff fear has very long legs.
And the target they list there is the psychological level of 5,310. But say you're a bit more cautious, maybe looking for a slightly safer entry, you're probably leaning toward Execution B, the polarity retest.
Yeah, the safer bet. This relies on what they call the value area. The analysis suggests waiting for the price to dip back into that 5,107 to 5,125 zone.
Yeah.
Basically right where the buying frenzy started this morning.
The logic being that the breakout point often turns into a support floor, so you get a much better price. But obviously the risk there is that
The train just leaves the station without you.
Right.
That is the trade-off. Now, if you want something in the middle, something with active management, the report suggests Execution C, the trend surfer. This is purely mechanical. You pull up a 5-minute chart and you watch the 20-period exponential moving average, or EMA.
So this is basically the don't think, just follow method. As long as the price stays above that EMA line, you just hold the position.
Precisely. And your exit is strictly defined. If a 5-minute candle closes more than $5 below that line, you get out. It takes the emotion completely out of the equation when you're dealing with this kind of volatility.
Which is vital. But here is where it gets really interesting and frankly a little scary. We have to talk about the risk advisory section in this document. It flags a very specific technical warning called ATR divergence.
Yeah, this is a crucial warning sign to pay attention to. ATR, or average true range, measures volatility. Usually when a price skyrockets the way gold is today, volatility goes up right alongside it. But today, even though the price is up 2.4%, the ATR is actually down 2.0%.
Which is totally counterintuitive. It suggests the rally might be, running on fumes?
Yes, exactly. That specific divergence often precedes a blow-off top, which is where the buying energy just exhausts itself and the price suddenly collapses.
Plus, the document highlights the headline risk. Gold is deeply in overbought territory right now. The report warns that if there's even a whisper of de-escalation, say the actual tariff implementation gets delayed or watered down, we could see a rapid $50 to $100 correction right back toward that 5,000 baseline.
Because the market has already priced in a 15% tariff world, literally overnight. Any walkback from the administration would deflate this specific trade instantly. And again, we're just looking at the market mechanics here, not taking political sides. But that headline sensitivity is a massive risk factor.
Definitely. Which brings us to a final thought for you to chew on today. This entire historic rally is built purely on the fear of economic damage from tariffs. But if the market has already priced in the absolute worst-case scenario overnight, what happens to your safe haven asset if the reality turns out to be just slightly less terrible than predicted? Does safety actually become the riskiest trade of all?
That is the multi-billion-dollar question every trader needs to be asking themselves right now.
Absolutely. Well, thanks for taking this deep dive with us today. Keep an eye on those charts, and we will catch you on the next one.